A very warm welcome to all of you for the Kotak Wealth Management April Market Update. I'm Oisharya and with me is Rajesh Iyer. Welcome back, Rajesh.
Hi.
Let's start with equities first. The earnings season in Q4 has been a mixed bag, with IT being subdued and financial, especially in the private sector and energy, being okay. So what are our expectations for Q4 and FY17?
So we believe the Q4 earnings in pharma is expected to remain muted, primarily due to the US FDA related issues. While in auto, specifically in the two-wheelers, due to the BS4 write-offs, there will be some pressure. While metals earnings growth will see some pickup due to low base, while PSU banks and construction will see some momentum. So net, we could see anywhere about 9 to 10% earnings growth for Q4, while the whole year could see about 8 to 9% thanks to the last two quarters of good earnings growth. And going forward for FY18, the earnings growth is estimated around 17%, primarily driven by banks, corporate banks, and metals and mining, energy, which are all low P sectors, whereas the high P sectors like consumers and pharma are going to struggle during this fiscal.
The Nifty at 9,300 levels is already at 17.8 times 1 year forward. What strategies should our investors adopt and focus on at this level?
We still believe bottom-up investment styles, as in the managed strategies, continue to make a lot of sense. For example, if you look at the earnings growth in terms of all these managed strategies, on an average it's about 26%, whereas the price to earnings ratio, the PE ratio, is just about 18.5, versus all the mid-cap mutual funds are trading at about 24 times with the same or similar earnings growth. So net, we believe that managed strategies is something which makes sense compared to any of these small and mid-cap mutual funds. And for any fresh flows, we would advise investment on day one into these managed strategies, while on the large cap mutual funds, 25% of the amount goes on day one, while the rest is systematically invested over the next 2 months.
So let's go to debt now. The RBI policy at the start of the month has dented all ray of hope on a rate cut. What's your sense?
Well, the RBI policy is in line with our expectations, so no rate cut, as well as there is clarity on liquidity. The RBI policy is focused more on inflation, while the inflation figure today is lesser than 4, but our expectation at the end of March 2018 is that the inflation should be around 4.5, while RBI still expects it to be 5%. So for any rate cut, a 4% inflation has to sustain over a period of time, which today looks to be a little not possible, and that is why the rate cut expectations have evaporated.
So how are markets reacting to this change? In fact, there's a noise on rate hike which is already gaining ground.
Yes, the mood is definitely cautious and the 10-year yields are under upward pressure. In fact, one of the MPC members of RBI hinted on a 25 basis points preemptive hike. The two most important variables, liquidity, which gave support for the last 6 months, is something that the RBI will slowly absorb out. The second most important variable was the OMO purchases, which actually supported all the GSEC supply, is something which is not going to happen this year. In fact, we saw unsold stock in terms of the latest 10-year benchmark auction, which has not happened for a long period of time, which also indicates a lack of interest in terms of any risk appetite. So the only positive looks to be the FPI flows of about $7.5 billion, which happened in the month of April, which is equivalent to the full 2016 inflows that we've seen. But we do not believe that this will sustain over the next 12 months.
So what could alter the direction again for rates?
So the big international factor remains the US Fed, and if there is sense that the rate hike in the US may not happen, then the domestic rates may remain low for some time. Having said that, the RBI focus domestically is on inflation, and 55% of this inflation consists of education, health, transport, etc., which, if it can be sustainably brought down and the 4% sustained, there is room for the 6.25% repo rate to come down. However, we expect the rates to be on hold given the global headwinds as well as inflation pressures in the near term.
So what are we recommending on the debt side given our outlook?
We continue to focus on simple carry and coupon assets as we believe that duration and trading strategies are risky. So we recommend accrual funds as well as high yield funds. We also do advise a little bit of exposure towards perpetual bonds as well as small finance bank moderate duration bonds.
Well, thank you, Rajesh.
Thank you.
Thank you all for joining us. Do write into us if you have any feedback. Have a great month ahead and look forward to seeing you soon.